With me now are two men with some serious skin in the game in the market. It's Mario Gabelli, the founder and chairman and CEO of $47 billion money management firm Gamco Investors, and Leon Cooperman joining me as well, the founder, chairman, and CEO of hedge fund firm Omega Advisors. Both, of course, are huge, legendary value investors. Lee and Mario, great to see you today.
Terrific to be here.
Together? Okay, so I've got this huge brain trust here. Tell me first on Greece. Are we at the breaking point here? I mean, are we going to look back and say this is the end of the bull market on this day?
I would be very surprised if that was the case. You know, stepping back, let's face it, the market doesn't like uncertainty, and it does not like negative surprises. Most people, ourselves included, felt the deal would be worked out. So what's happened over the weekend
and look at what
was a negative
happened.
Surprise. Having said that, to step back, Greece represents less than 0.2% of global GDP. And less than 0.2% of global markets. So it's hard for me to imagine that this would be a major event for markets. Most of Greek debt is held by, quasi-governmental institutions, not by the private sector.
Right.
So it's unfortunate. Anything could still happen, but I don't think there's an event that the market's making it out to be.
How about you, Mario?
Well, I'm not dissimilar. I mean, there's 3.2 million people, and Lee mentioned the size of their GDP versus the $75 trillion is de minimis. But like what happened with Lehman Brothers, when that went bust, it was the reserve fund that had a little piece of Lehman that created a problem. So we're still waiting for the ripple effect. Notwithstanding that, the market is reacting to it as it's supposed to, and that gives you opportunities to look for things we like. And for it's the pause that refreshes. The economy in the U.S.
Does it refresh?
Yes, the economy in the United States is reasonably good. I think Japan will do well in 2016. I think China's going to get their act together. I think Draghi, even with this minus background noise, will have Europe humming. And the United States will continue to do well. So if there's a sharp decline, I think it's a V in the market.
I would just say the only difference, and a major difference between Lehman and Greece, is Lehman's debt was held by the private sector.
That's
right.
Correct.
Most of the debt in Greece is held by quasi-governmental agencies. So I think it's a very big difference.
So if you were to place
materially different than in 2010-11. And what Lee pointed out is where the debt is owed.
That's
today.
true. But if you were to put your bets, what would you say is a percentage chance that we will see Greece leave the euro?
I can only tell you what I read from people that are more knowledgeable than myself.
Which is?
The general feeling is less than 50%.
Less than 50, okay.
Well, it's very complex, but, Germany does not want them to leave the euro. Merkel was quoted this morning saying, if the euro fails, Europe fails.
Right.
Okay, now Germany's been a major beneficiary of Greeks being in the euro because it's kept the euro artificially depressed, which gives Germany a major trade advantage. So if the euro blows apart and the Deutsche Mark starts trading again, Germany becomes priced out of the marketplace as a major exporter, so it's a big issue.
Right.
I'd say, something greater than 50%. They're calling for this referendum. The general feeling is the man and the lady, the people in the street in Greece want to stay in the EU, so they vote in favor of staying in the EU. Then Tsipras says whatever, he's out, and they'll have to call a new government. And the IMF will say, well, because the Greek people voted to stay in the EU, we're going to extend our offer to you, and everybody lives happily ever after. Just keep in mind, I think in the last 150 years, Greece has been either restructuring or in default. I'm told 92 out of 150 years.
Right. We've been here before.
Yeah, and you get a lot of crises all the time. And we remember we went from Iceland to Latvia to Ireland to so on. And this is another one. But it was reasonably well anticipated, except for the short-term dynamics.
Well, Lee, one of the things back here in the U.S., though, I remember one time sitting in your office and you were showing me these charts about, Mario was talking about, look, the U.S. is still growing. I mean, look, this is a market that is still seeing some great dynamics here. But I remember sitting in your office and you were showing me charts about how the bull market will continue. There are no signs of a recession right now, but it'll continue. But it usually begins to end after a Fed rate hike. Right?
No, I'd be more specific if I have the time. I said, generally speaking, bear markets come about for one of four reasons. First reason is the stock market's a leading indicator. It's very smart. It smells the onslaught of recession, starts to decline before the recession hits. Mario just went through a whole series of data. There's no signs of recession on the horizon. Fact of the matter is, most things I'm reading saying the U.S. is starting to accelerate a little bit. That's not there. The second is the market becomes very exuberant. It's pricing, overvalued, vulnerable to a decline.
And you don't see that?
Well, 10-year government is 2.1%. Short rates are 0. The multiple in the market, 16.5 to 17 times. Doesn't seem to be out of line. The third, which you can't forecast, is a major geopolitical event. Which could hit you out of the blue. Maybe it's Greece.
Could be Greece.
I doubt it. I doubt it. We discussed the numbers. It's 0.2% of GDP, 0.2% of the global market. It could be Russia, Ukraine.
It could be Iran. It could be
a lot of different things. And the fourth thing, getting to the point you just raised, is the Fed takes the punch out of the punch bowl. And everybody is focused on that, but this is the statistics. There have been 8 tightening cycles since the mid-1950s. Okay, on average, the market rose for close to 30 months after the first Fed rate hike, and the shortest period of time the market rose was 10 months. The second statistic, if you take the average of those 8 cycles, 1 year after the first Fed rate hike, the market on average was a little bit less than 10% higher.
Okay.
And so I would say I'm not worried about the Fed. In fact, I would be more worried if we sat here, Mario and I, one of my great friends, sat here a year from today and the Fed did nothing, because it would suggest the economy was
You'd be more
weak.
worried about that. How about you, Mario?
No, if the rates go up very sharply, the market will have a...
But that's not going to happen.
No, I agree. So therefore, but if it did, you would have a correction, and I think that would then work its way through the system. So the market has baked in part, an increase in rates. The 231 that Lee mentioned on the 10-year has been backing up. So I think there's a limited margin of safety in the markets, but I think it's okay.
Are you able to find bargains still? Yeah?
And he spends his whole life looking for bargains.
Every time I read an
I know, he digs through all the data. And
I read the annual report of McKesson over the weekend. I got the Legg Mason. I went to see a company in New Jersey this morning that I prefer not mentioning. And you're always finding things that are good. For example, in the next week, there are 3 or 4 companies that are going to be spun off. Lilac, which is a Latin American cable operation, a tracking stock of John Malone. There's a Tegna, which is a Gannett broadcasting business. You talked about 14 candidates for president on one side of the ledger.
Yeah.
There's going to be 15. They're all going to spend on advertising. There's a tsunami.
It's going to grow to 16, 17. Okay, can I just quickly mention Charlie Ergen?
Michael Bloomberg is running? Announced. Number 17.
Not yet. Shh. No, I'm just
I have a very large position in Dish.
Yes, Dish.
Yeah, I get a
Both of you are in Dish.
Yeah, well, I've had it for a long time. I'm sure Mario has it for a long time. I'm a very big fan of Charlie Ergen, and I get a kick out of the following. Like, these 20-year-old analysts are trying to second-guess a guy that maybe, I don't know, has $15 billion net worth that he's built up in...
$20 billion.
$20 billion. I haven't counted. The guy is smart. And the guy's going to do it right for the shareholders because he owns a big chunk of the company.
Well, guys, just listen to... So we sat down with Charlie Ergen, finally, right, after years of going after this man. So he finally sat down, and this is what he said about a possible merger with T-Mobile. I want you to listen to what he said about that.
And I think that there are certainly a lot of positives to that if there's willing participants, but they certainly have done a fantastic job in kind of being the upstart company, the uncarrier, so to speak. So John Ledger and his team have really captured the imagination of the public in terms of attacking the pain points that we have in the wireless industry. Their network is very similar to our spectrum position, so it fits in that sense. And of course, obviously, their growth rate, they're going to need more spectrum. So those things make some sense.
Does it make sense?
Well, there's no question that Charlie has accumulated a great deal of assets. Lee mentioned 500 million shares at a $70 stock, 35 billion market cap. It's in the world that we're living in this kind of economy and stock market appraisal, that's a pretty cheap stock. And so is it attractive on its own? Is it more attractive with a deal? Is Charlie going to do something? Yes, yes, yes.
But couldn't he extract that? Couldn't he just spin off his spectrum and you'd see the stock climb?
Well, if you mark to market the spectrum, and I don't want to use the AWS-3 auction that just ended because there were some issues.
Yes.
But on balance, he has spectrum. He's accumulated it. He wants to use it. Spectrum has no value at the end of 15 years if you don't use it, so you have to have an economic purpose. And there are those that need it because of the growth in data. And Charlie's center row orchestra and those that want to be romanced or will romance.
How about you, Lee?
I was surprised they didn't split the company into two to separate the spectrum, but there may be tax issues that inhibit that from happening. Because if you did something like that, you probably couldn't do anything for a couple of years, and the industry is moving very fast. But you got to basically accept the notion that the man is very, very smart. He's built this company, and he's going to figure out what to do that's the right thing for the shareholders. And maybe there'll be a competition. You know, you can't get the best price for any asset unless there's more than one person that wants to buy it.
True.
So maybe, you know, he gets into play here. But I'm willing to bet on Charlie rather than some 21-year-old analyst that barely can make a payroll.
Right. Who's trying to game out what he's going to do.
I'll ride his coattails because he's very smart and he's got a major investment, and there's nothing wrong with that.
We are back with hedge fund manager Leon Cooperman of Omega Advisors and mutual fund manager Mario Gabelli of Gamco Investors. And guys, I want to pivot from the markets to politics, right? I mean, you had just mentioned all those candidates, the slate of candidates for the Republican nomination. So as if we need any kind of reminder of how hedge fund managers or the 1% are viewed, right? Remember what Democrat Hillary Clinton said recently about hedge fund managers?
You see corporations making record profits with CEOs making record pay, but your paychecks have barely budged. While many of you are working multiple jobs to make ends meet, you see the top 25 hedge fund managers making more than all of America's kindergarten teachers combined, and often paying a lower tax rate.
And Lee, I know you were interviewed by CNN in reaction to some of these comments, and you said to Hillary Clinton to cut the crap.
Well, look, it's a very complicated issue. I believe wealthy people should pay more in taxes.
I agree.
I believe I'm my brother's keeper. As you know, I've taken the giving pledge with Buffett
with Warren
and Gates.
Buffett. But do you pay more in taxes on a percentage basis?
I honestly don't.
Than Warren Buffett or the average person?
Than the average person.
The average person that makes less than $40,000 and gets an earned income credit does not pay much in taxes.
True.
So as a result,
but let's talk about the middle class family.
The middle class family in the United States pays $50,000 and have gotten significant tax base. What we need to do is give them more earned income tax credits. We need to encourage those that are working. We need to take and revitalize the notion of the American dream. And Lee has, for example, been inducted into Horatio Alger because he started with little and has created a lot by hard work and what he learned in the educational system. And what Hillary should be doing is, and everyone should be doing, is saying we can all do it together. Let's share. Let's recapture the American vision. So I'm not into politics, but I do think that the American way certainly has worked among all the poor choices in the world over the last couple of 100 years of allocating capital.
But do you feel it's going to be any different this time around than it was in the last election?
Worse. It's getting worse.
How?
Because of the income disparity that exists. But the income disparity is not the fault of the 1%. In other words, I would argue, and it's not criticizing any one individual, but Mr. Bernanke understood that he wanted to get the economy going. He felt the best way to get the economy going was to create wealth. Because if he created wealth, he could create consumption. If he create consumption, he create employment. And he figured the best way to get at it was to get the stock market up, to create the wealth, to create the consumption, to create the jobs. The trouble is, 80% of stocks are owned by a handful of people. And the failing is not to put on the president's doorstep, but the failing is that the entire burden of dealing with the significant financial crisis that began in 2008 has been put on the doorsteps of the central bank. We've not seen intelligent fiscal policies to create employment.
So you blame the central bank for the economy?
No. I'm saying I'm blaming
the fiscal side.
That's one cylinder
that's working, but the fiscal side, the government, there's no
jobs, programs, bring back retained
infrastructure.
earnings.
How do we create the infrastructure that is a fundamental dynamic with regards to growing the economy and helping many of those that are structurally unemployed? Right. It's a no-brainer. Drive around anywhere in terms of roads, the highway build, bridges, the congestion.
Why don't they show leadership? Consider instituting a gasoline tax because of the windfall from the decline in gasoline prices.
Right.
Take that money and put it into infrastructure building.
Create jobs.
Trillions of dollars offshore, and a lot of these technology companies laying there because of the adverse tax consequences. Maybe give a tax holiday tied to hiring or construction.
Well, you have to restructure the entire tax code.
But we're doing everything on the monetary side and nothing on the fiscal side.
And nothing on the fiscal
Which
side.
is the problem of the absence of leadership at the fiscal side.
Well, and you had said, you said this a while ago, right? Or maybe you said this on Wall Street Week. Well, you said you'd written a letter to Obama.
Look,
and then you got audited.
I love Mario because we have the same value system. You know, birds of a feather flock together. We bet at Columbia almost 50 years ago.
Right. Okay. And I know I know Gamco recently, with Columbia Business School, they had named you Value Investor of the Year.
They gave me an award. It was very nice. But anything Mario gives me...
Can I get an award, too?
Be Jordan Sababis. We have a great respect for one another. But basically, my point is, we both started. He was in a very Tony section of the Bronx. I was in the rough and tumble South Bronx. Okay. The only thing that's changed about Mario, which is what I love, is the color of his hair. Well, I knew him was a redhead. Now he's got a full head of gray hair. Okay, but he's generous.
You know how long it took to get this color?
He worked on it.
But are you afraid? But because you speak out a lot, both of you do, actually. But do you worry about speaking out? And that
this is America.
And that could raise the ire of the government.
There's no question that there are groups that do not like people to speak out, whether it is at Bloomberg or Gamco or Omega or in the particularly politicians.
Right.
So it is what it is.
Well, this is what I'm leaning to.
But the good news is you can do it here.
You can.
Generally.
Speaking about the income gap, though, Mario, you know this, right? The SEC might be issuing a rule, I believe, in the next few weeks, where they're going to ask public companies to publish the ratio between how much the CEO earns to the typical worker at their company, right? They want to see what that ratio is. Is that? I'm just asking. Is that helpful?
To who?
Is it helpful in valuing a company?
Investors are not necessarily focused on that. They would like to know whether you're going to have instead of a GAAP standard, have an IFRS International Financial Reporting System standard. They want to understand more intimately the details of certain things. But we live in a social society. It's a living, reading document. If the regulators want to have that, they'll report it. But it's not material incrementally because the analysts know, basically reading on the proxies, what CEOs make.
It's a very complex problem. My reason for writing to the president is he was creating at that time sort of an element of class warfare. He was trying to tell the 99% people that the 1% are screwing them. And the 1% I know have been extraordinarily generous in giving back. And I think whatever I say about myself, I can say about Mario, I can say about 50 friends of mine. They started with very little, they worked very hard, they got lucky, they made a great deal of money, and they're giving it back to the system. That's the American dream. That's what we should emulate, not criticize. Okay. Hillary Clinton's commentary is inflammatory. She's going to the lowest common denominator. It's class hatred, class warfare. We should all, the 99% are not going to prosper if you drag down the 1%. You got to bring the 99% up to give them an opportunity. It's through education and other things of that nature that I'm not smart enough to.
Plus a safety net. We don't have a problem with anything.
By the way, has it gotten less fun? Let's say we go through another round of criticism in this election. We go through another round of even tougher regulation, and the markets go kaput, and it's just like 2007, 2008 again. Are you going to hang your head?
I'm not expecting
No, I'm just,
that.
But I'm curious. Has it gotten less fun?
Well, you got a hypothesis on the markets. Notwithstanding that, the point is that we like to compete on behalf of our clients against the best minds in the world, against what we do in terms of methodology and philosophy. And some years, like Ted Williams, he made out 3 out of 5 times, but he was the best hitter of all time. That's what we intend to do.
You never want to hand the keys over to your kids and say, you take over now?
Well, I have a kid that competes with me. I have 2 kids. One
at Omega?
No, he has his own firm.
I hope he does better than him because I got money with both of them.
Yeah, basically, it's very complex. You're touching on a very, very important subject, but it's not an easy answer. Okay, and I don't know. We have to spend an hour, 2 hours, 3 hours developing it.
All right. Well, I know we're grabbing lunch, so let's just talk about it then, guys. All right, Lee, thank you so much for joining me. Great to see you, Lee Cooperman of Omega.
Thank you.
Mario, great to see you as always.
You too.